You spent your whole life being responsible with money. You earned it, you did not gamble it. You put it somewhere safe, a bank, a savings account, something steady, because that is what careful people do. So here's the quiet fear almost nobody says out loud. What if the safe choice is about to become the dangerous one? What if the money you spent 30 years building could lose a third of what it can actually buy, and you would never once see it leave your account? No crash, no headline, just a little less every single month, while the number on your screen keeps telling you everything is fine. Ray Dalio, the man who built the largest hedge fund on earth, has put a date on when that shift begins, and it is closer than you think. In about 100 days, on November 3rd, America votes in the midterm elections, and his warning is blunt. The real danger does not start on election day. It starts the morning after. His word directly: we are on the brink of some of these problems. And that window opens the day after you vote. So if you have more than $50,000 saved right now in a bank account, a money market fund, or retirement account sitting mostly in dollars, what happens after November could quietly change how much that money is worth. Not the number on your statement. That stays the same. What changes is what it buys at the store. 50,000 saved, 100 days left, then everything changes. And I'm not going to make you wait 20 minutes for the point. Here it is, and then I will prove every piece of it. After November, the most likely path is not a crash you can see coming. It is the government quietly letting inflation outrun your savings to survive its own debt. And the people who played it safe are the ones who pay for it. But there is a defense. It is the same move central banks are making right now, in real time, and it takes about 15 minutes to set up. So stay with me, because understanding why this is happening is what will actually get you to act before it is too late. If that is what you came for, hit subscribe now. One thing first, and it matters. This video is macro analysis and education. It is not personal financial advice. Everything you are about to hear comes from Ray Dalio's public work and the historical pattern he studies. What you do with your own money is entirely your decision. And honestly, a decision best made with a licensed advisor who knows your actual situation. With that on the record, let us keep going, because this is not a random voice online telling you the sky is falling. Ray Dalio founded Bridgewater Associates and built it into the largest hedge fund in the world. He has spent decades studying how debt, currencies, and entire empires rise and fall, not over quarters, but across 500 years of financial history. He literally wrote the book on big debt crises. So when a man who has spent his life watching this machine from the inside starts compressing his timeline from a decade out to just the next 2 years, that is not background noise. That is the signal. On the Prof. SG Markets podcast, Dalio said the next 2 to 3 years would be like traversing a time warp. He described 3 storms forming at once: debt, geopolitics, and the artificial intelligence boom, all colliding in the same narrow window. And he kept coming back to the arithmetic underneath it. So let us start there, because once the numbers are in front of you, the urgency stops being emotional and becomes mathematical. The federal government currently spends roughly $7 trillion a year. It takes in roughly $5 trillion. That is a $2 trillion gap every single year with no end in sight. In Dalio's own framing, the government is running about 40% overspending. Say that slowly. For every $5 it collects, it spends $7. To cover that gap, the Treasury does what any borrower does. It issues debt, bonds that promise future dollars at a set rate. And somebody has to buy those bonds. For decades, 3 groups have absorbed United States debt at scale: American households and pension funds, domestic banks and corporations, and foreign central banks: China, Japan, and Europe, the largest. Hold that third group in your mind, because that is the leg that is buckling right now. And look at what is already piled up. Total federal debt now sits above $39 trillion. The government is borrowing around $155 billion every single month just to function. And the interest bill, just the interest on money already borrowed, has crossed $1 trillion a year. Let me translate that. The United States now spends more on interest than on national defense, more than on Medicare. Interest on the debt is now the second largest line in the entire federal budget, behind only Social Security. Sit with that. The fastest growing expense your government has is the cost of the debt it already owes. Dalio's phrase for this is precise. He says the debt is squeezing the economy like plaque in the arteries. And a doctor, he says, would warn of a heart attack. In a single quarter this year, interest costs alone swallowed nearly half of the entire deficit. The math compounds against itself because every extra dollar of interest has to be borrowed too at the same higher rate. The spiral does not need a villain, it just needs time. So here's what I want you to do right now. Open your phone, open your banking app, look at your savings account rate, look at the yield on any money market fund you hold. Whatever number you are looking at, write it down somewhere, on paper, right now, because that number is about to become one of two things, either the floor of what comes next or the ceiling of what you missed. And quick gut check before we go deeper, because I read every single one of these. In one word, is your money right now mostly in cash, mostly in stocks, or already in gold? Drop that one word in the comments. And then the real question, the one I actually want you to answer, do you still trust the dollar? Just yes or no. Because if you hesitated even for a second, if some part of you is not sure your money is as safe as they keep telling you it is, that hesitation is exactly what the rest of this video is about. Now let me show you why November specifically is the moment this tips. Because three separate pressures are about to arrive in the same room at the same time, and they are not three risks. They are three doors to the same room. Door number one, the refinancing wall. This is the piece almost nobody explains. Over the last decade, the United States borrowed trillions when money was nearly free, at rates close to zero. That was the cheap money era. But bonds come due, and right now the Treasury has to refinance somewhere around $8 to $9 trillion of debt in the next 12 months alone. One analyst flatly called it a bonkers record high. Here is the problem. That debt was issued at almost zero. It has to be rolled over at today's rates, 4, even 5%. You do not need a finance degree to feel that. The average rate the government pays is already more than doubled from where it was 5 years ago, and it climbs every month as cheap old debt gets swapped for expensive new debt. Door number two, political paralysis. This is Dalio's own forecast, and it is exactly why the election date matters. Heading into the midterms, the economy is soft and the political map is contested. Dalio's baseline view is that after November, Congress ends up divided and gridlocked, unable to agree on anything. Now, translate that into money. The 7 trillion versus 5 trillion problem cannot be solved without political consensus. And consensus is impossible in a paralyzed Congress. So at the exact moment the country most needs its government to act on the debt, its government becomes incapable of acting at all. Door number three. The foreign buyers are walking away. Remember that third group of bond buyers? China has been a net seller of United States debt for multiple quarters running. Its holdings have fallen to their lowest level since 2008. And while China sells United States bonds, it is buying gold at a record pace. Japan has trimmed its holdings too. So at the exact moment the Treasury needs to sell more debt than ever, its biggest historical customers are quietly heading for the door. Let me make this click with a story because the mechanism is simpler than it sounds. Imagine you rent an apartment. Rent is $7,000 a month. Your paycheck is $5,000. Every month you come up $2,000 short, so you borrow it. You have 3 friends who lean to you, no questions asked, because they trust you. You pay a little interest, they earn a steady return, everyone is happy. That has been the United States for 40 years. Now, one day, the biggest of your 3 friends quietly stops answering your calls. The second says they have their own problems. Try next month. The third says, fine, I will still lend, but I need a higher rate now because I can see I am the only one left. So you find a 4th lender who never lent to you before, and you offer a higher rate to get them in the door. But the second you do, your original friends realize you are paying 10 to the new guy while they are stuck earning 4% on the loans they already made you. So now they want out too. They start dumping your old IOUs to anyone who will buy them. But nobody pays full price for the debt of a borrower who is suddenly paying 10% to someone else. So the value of those old IOUs drops. Everyone holding your debt gets poorer at the same moment, and your cost to borrow one more dollar just jumped. That is not a metaphor. That is a treasury auction. And the first cracks in foreign demand do not arrive with a headline. They show up quietly in the higher yields buyers start demanding at a single boring bond auction. By the time it makes the news, the repricing has already begun. 3 doors, the same room, and the door opens in November. Let me make this real for a second, because it is easy to drown in trillions and forget what they actually mean. Imagine you were 62, you just retired, 40 years of work, 40 years of saving a piece of every paycheck, doing everything the careful, responsible way, and you have finally built enough to last 20 years, enough to be comfortable, enough to stop worrying. Now imagine that money quietly losing value every single month, not in a crash you can see, not in a headline. The number on the statement never even moves. But the groceries cost more, the medicine costs more, the little you set aside for the grandkids does not go as far. And a year in, the savings you built to last 20 years only stretch to 15, then 12. Not because you invested badly, because you invested safely, because you did exactly what they told you was the smart, careful thing to do. That is what all of this actually means, not numbers on a screen. A retirement quietly shrinking for the person who trusted the system the most. And now let me show you the one thing that could make it happen faster than anyone expects. It is hiding in a corner of the market most people have never heard of: private credit. Just last month, the Bank for International Settlements, the central bank of central banks, named the 3 biggest threats to the entire financial system an artificial intelligence spending bust, a wave of hidden private credit that looks disturbingly like 2008, and record government debt, all feeding each other. Here is why it matters to you. Private credit is a roughly $3 trillion pool of loans made outside the normal banking system with almost no transparency, much of it now funding the artificial intelligence boom. And the stress is already showing. Some of these funds have blocked investors from pulling their own money out. People ask for their cash back and we're told no. The BIS put it in one line: leverage does not disappear by being out of sight. It is the same trick that turned a housing problem into a global crisis in 2008. And if it cracks, it feeds straight back into the debt problem Dalio was warning about. That is how a first domino falls. Not from the front page, from the corner nobody was watching. So let me stop being abstract and walk you through exactly what the months after November most likely look like step by step, because this is the part the title is really about. Start on election night. The results come in and Congress splits, divided, gridlocked, unable to agree on anything. That is Dalio's baseline call. And the moment it happens, the one thing that could actually fix the debt, Washington cutting spending or raising revenue together, is off the table, frozen for 2 years. But the debt does not freeze with it. This is the part people miss. The refinancing wall does not care who won the election. Trillions of dollars of old cheap debt heat coming due month after month. And every dollar of it has to be rolled over at today's rates, 5% instead of near 0. So the interest bill keeps climbing automatically, no vote required. Dalio's own line for where that leaves us past the point of no return. Now watch where the pressure goes. With Congress paralyzed, there's only one institution left that can do anything: the Federal Reserve. And the political demand on it will be loud and simple: cut rates, make the debt cheaper, keep the machine running. This is the exact trap Dalio has been warning about. Because the only way to make a mountain of debt survivable is to hold interest rates below the rate of inflation. The 1930s playbook he named by name. He stopped short of guaranteeing it. His exact words: "I am not saying we are going that far, but that is the direction every single arrow is pointing. And here is what that does to your money concretely, not in theory. Your bank statement still says $50,000. The number never drops. Nothing on the screen ever looks wrong. But month by month, quietly, inflation runs a little faster than the interest your savings earn. So the $50,000 that covered a certain amount of groceries, gas, and rent in November covers a little less by spring, and less again by next fall. Give it 18 to 24 months and the same 50,000 sitting on your statement has the buying power of 45,000. And 42, you did not lose a single dollar on paper. Your dollars lost you. That is exactly what Dalio means when he says one man's debts are another man's assets. The government's debt gets lighter by quietly making your savings wider, and the bill lands silently on the person who did the responsible thing and kept their money in cash. That is what everything changes actually looks like. Not a headline, not a crash you can point to and say, there it is, just your grocery bill quietly outrunning your bank statement month after month, while the number on the screen keeps telling you everything is fine. And it could arrive faster than the slow version. Remember that second domino.